Today we are going to cover how to identify when stocks are on sale. And by on sale, I mean stocks that have dipped in recent times. So to do so, we have to move away from the actual platform that we use to invest. In my case, the Trading 212 platform. For those who are new to this channel, there is a link in the description which will provide you with a free stock up to £100. All you need to do is insert £30 and you will receive your free stock. So we need to move away from the platform and use other tools as a way to dig deeper into how we analyze stocks. So up until now, we've generally looked at a given stock, in my case, added the candlesticks, and we've used past indicators or past performances to identify when a stock is on sale or not. So looking at the Boeing example here, it dropped in recent times. We can see there's a resistive level at the $320 mark, and we can use that as an indicator to buy a given stock or not. So in the case of dividend-based stocks, which is probably 95% of our focus, so I haven't revealed this type of analysis in the past just because I wanted to keep our analysis as basic as possible, but it's an extremely important strategy for dividend-based stocks. So let's look at the first website, and it's seekingalpha.com. I will add a link in the description, and this website is crowdsourced, so in terms of any latest information, individuals are sort of free to write information, but there's a search bar at the top where you can enter the ticker symbol, which I have done for Apple. So this website is great for US-based stocks, but not that good for the likes of UK-based stocks. And so looking at the example here, we have Apple. So on the page here, the first thing I look at is the payout ratio. Now, the meaning of payout ratio is simply the amount of earnings a company makes in a given year and how much of those earnings are distributed to shareholders. So in this case, 26.27% is given to shareholders in the form of dividends. The rest of the money, i.e. the 74%, is kept within the company, and the company can use that money just to grow bigger and bigger. I think below sort of the 35% range is a very healthy company. They're able to pay dividends, but they're not using all of the earnings to pay out that given dividend to shareholders. So very happy with the payout ratio. So the next section to look at is what's called the dividend yield, and that's simply the amount of dividend you will receive as a percentage for a given year. So for the likes of Apple, it's evident that the dividend yield is very low, but perhaps if you are buying the stock, the main focus isn't on receiving dividends, but it's more on the appreciation of the underlying stock as time goes on. So these figures are the first two that I look at, but then on top of that, in terms of a purely dividend-based stock, i.e. wanting to earn money based on the dividends, I will then look at the dividend yield. So the dividend yield just gives us a plot over time and how that dividend yield has changed throughout the years. So if we look at recent times, we can see how the dividend yield is extremely low, probably sort of all-time low in the last 5 years or so. And this is an indicator that if you're trying to buy stock just based on dividends, then this isn't a great buy. You would want to have a higher dividend yield. So for those investors who brought back in early 2019, we're at sort of the 2% dividend yield range now. 2% still isn't high, but it's a lot better than recent times. And then for those investors who brought back in early 2016, they would have had a dividend of around 2.3%. So for those who are considering a stock appreciation, then Apple could still be a good company. To just look at the kind of stock appreciation, we would want to just use any kind of platform, and using our previous analysis, we can see we're at all-time highs. So let's just zoom out the 1 week graph. Yeah, all-time highs. So even on the month chart as well, we've never hit a price point in the 240 ever. This is brand new territory. So that's not to say in the future this can grow even more, but from my perspective, the stock is an all-time high in terms of stock appreciation. And then in terms of dividends, they're close to an all-time low. So for me, this is not a great time to buy Apple. And so with our new skills, such as looking at the dividend yield over time and looking at just the dividend yield, the current dividend yield, and also looking at the payout ratio, we can combine all these factors to decide if a stock is on sale or not. And in this case for Apple, it's definitely not the case. So that's enough for US-based stocks. Seeking Alpha is a great website to perform these types of technical analysis. The downside, however, is that for those that are interested in UK-based stocks, or even those in Europe, for instance, they are unable to use Seeking Alpha as the primary source of information. And unfortunately, for those that are looking into UK-based stocks, there isn't a single website that I've come across so far that encapsulates all the information that we need, such as Seeking Alpha has. So hopefully in the future, Seeking Alpha will expand for UK-based stocks and for other markets as well, but that's not the case right now. So for those who are interested in UK-based stocks and primarily dividend-based UK stocks, there is this website shown on my screen. I will provide the link in the description. Now, sometimes it's easier just to manipulate the URL within the browser. So epic equals, and then you just define the ticker symbol, which I've done here. And this brings up a graph of the dividend yield over time. So at the moment, we're on the 1 year history. We have options for 5 year, 10 year and max. So looking at the 5 year history, we can perform the same analysis that we did on the Seeking Alpha website. So for Lloyd's, this stock could arguably be said to be in sort of the danger zone, because we generally don't want a stock that pays dividends higher than 6%. So we can see early of 2019 that was the case. We were above the 6% range, slightly above. But as it stands at the moment, we're in sort of just above this 5.25 line. Now that is a healthy number. So that gives me confidence that the dividend yield is a nice percentage. So on the 5 year graph, all indicators say that generally this stock is very good dividend yield. There has been times when they've overpaid, but that has been corrected by the company. So to have information such as the payout ratio, remember that's what we looked at the beginning with the Seeking Alpha website. But for UK stocks, it's not possible to do on this website. This is just based on dividend yields. So if we go to Yahoo Finance, which, believe it or not, Yahoo is good for something, we can enter Lloyd's ticker symbol. Now there's a few, but we're looking at the one that's listed on the London Stock Exchange, so the second one here. If we go onto the statistics page and just search for payout ratio, we can see it down on the page. So payout ratio, and the percentage here, 60, just above 60%. Earlier I said a payout ratio under the 35% is a good payout. It's a good ratio from what's being paid out to what's being kept within a company to grow further. So 35%, great number. When we go to sort of the 55% and above, that's when we can be a little bit more worried. It doesn't have to be a massive concern, but we're definitely in the territory where ideally we want to be in the 55% or lower. That's not the case with Lloyd's Banking Group. We're at the 60% range. We're 5% higher than we ideally would like to be. So that's something to keep in mind, but at the same time, there is a range and we're not sort of 75% or over. For instance, if a payout ratio was, even if it was in 70%, 75%, I would stay away from those types of companies. So unless the stock is a REIT, which we spoke about in a previous video, then we wouldn't want to go for a stock that's sort of 70% or higher. Now, 60% is still higher than we would like to be, but that is a decision that you have to make for yourself. For me, I'm generally okay with a 60% payout ratio. Hopefully over time that can improve. If it doesn't, then you have to ask yourself, should we be selling the underlying stock or not, if it seems quite unhealthy. So hopefully that was useful for US-based dividend stocks and the type of analysis that we have to make. Now, as I said earlier, unfortunately, we have to go. So as I said earlier, unfortunately, we have to use two websites to give ourselves a well-rounded form of technical analysis. Hopefully in the future that will change. So hopefully that was helpful for everyone, and I will catch you next time.